You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the Options Insider Radio Network. For you, the busy financial advisor, asset manager, maybe you're thinking about dipping those toes into the options waters. Given the year that we had in 2020, many of you probably already have. Maybe you're looking for a little bit of guidance on how to do it. Either way, we got you covered here on the Advisor's Option. My name is Mark Longo from the aforementioned network, as well as, of course, from the ever-exciting OptionsInsider.com. Reminding you, of course, wherever you get this content, could be on our site, could be via our app, could be on the legion, the litany of outlets on which it's available. Keep rating and reviewing. It really does help new folks discover this content in these troubled times. It's more important than ever. Of course, keep those questions and comments coming too. We do love to hear from all of you. We're just hot off the heels of our 100th episode. Spectacular last month. Matt and I still exhausted from all that fun. We had a lot of great special guests joining us. So we had to keep that fun. We had to keep that party going here with some other special guests joining us here today on the Advisor's Option. Before we get to our special guests, though, let me welcome on my cohort, my partner in all things Advisor's Option crime, none other than Mr. Matt Amberson, the principal over there at Options Research and Technology Services, a.k.a. ORATS, O-R-A-T-S. Mr. Amberson, welcome back to the Advisor's Option program, sir.
Thanks, Mark. Yeah, you're right. That was quite a show last month, and a little bird tells me that one of the voices that we heard might be heard this week.
You're right. He did join us last month virtually, so we thought it was only fair to bring him back proper on the show this month. Our old friend, Mr. John Cherry, now the president and global head of options over there at Northern Trust Security. John, welcome back to the Advisors Option. It has been too long, sir.
Mark, thank you. And Matt, always good to talk to you. And certainly, Mark, congratulations on the 100th episode. And very happy to talk to you both again today.
Crazy. This show to me is always still the little engine that could. The fact that it's been chugging along now for 100 episodes just brings a smile to my face. You know what else brings a smile to my face? Some of our new segments. So let's get to them with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement. You all know last year in particular, and certainly this year, no slouch either, but it's been such a tumultuous period in the markets and indeed on the program that we had to devote a lot of time at the top of every show just to kind of breaking down what's been going on from a markets and a volatility perspective. So we thought it made sense, beginning with our last show, episode 100, to encapsulate that in its own segment, because it doesn't look like that's going away anytime soon. So welcome to the P&L statement. Let's just set the table. When we were talking, Matt and I and all of our special guests on episode 100 last month, a little bit of a different vol regime than we're in right now. VIX cash was floating around a 28 at that time, so threatening a 30 handle not too long ago. Now coming into today's show, about almost 10 handles below that. Actually, it looks like it's bouncing a little bit now, but it was at about an 18 3/4, even a little bit lower this morning at the end of our Vol View show. I should know because I just won a crystal ball yet again, 2 weeks in a row, listeners, about a 19.5 towards the end of that show, but still obviously demonstrably lower than we were last month from a vol perspective. Markets also still pretty frothy, still pretty elevated, all of them at or near all-time highs, even though we have sold off a little bit over the course of the past week. There are still those concerns out there. Vaccines are rolling out. Are they rolling out at an aggressive enough pace? We're hearing whispers of places like here in Chicago where they're worried about the return of some numbers. Is there perhaps going to be more lockdowns coming as opposed to less? We're seeing that fear priced out farther out in the volatility structure. So it makes for an interesting time in the markets. It makes for an interesting time from a volatility perspective. So let's go around the horn. John, let's start with you as our guest. You haven't been on in a little while. I'm very curious what's been top of mind for you and your clients. We haven't had you on pretty much all of 2021. So what's been top of mind for your clients coming in now into 2021? Now that we're seeing the markets at these lofty highs, we're seeing vol continue to come in. Are they coming to you looking for more aggressive upside strategies? Are they looking for a lot more hedging? Are they concerned about these levels? What are you hearing from your clients, and what are you seeing out there, John?
Great. Thanks, Mark. I'll take it kind of in reverse order. With most recently as this week, many conversations about how investors should be thinking about playing boat jam. And what that means with respect to the things going on in the Suez Canal right now. I joke, but I do say that kind of anecdotally, but it is something that is top of mind for both asset owners and asset managers. In a bit more serious vein, inflation. Inflation has been the name of the game in thinking. Investors such as traditional fixed income investors thinking about what that could do to the equity markets and how to play it. So seeing some bullish bets both in single side options and spreads on precious metals. So kind of your traditional GOLD, GLD, SLV. Not a whole lot of volatility plays here and there for us, the traditional vol plays, but certainly seeing our normal systematic volumes, the ETFs, the EFA, the EEM, et cetera. With new capital going into those as well in the asset owner space, particularly foundations and endowments.
Like I mentioned, we haven't chatted with you in a little bit, so catch us up. I know you've been building out the options offering over there at Northern Trust. It seems like it's fairly new, but you've been there a couple of years now. In fact, you still hold the distinction, John. You are, I believe, the last person I spoke to in person before all this lockdown happened on the network. So you still hold that card as the final. It was at RMC last year, I do believe, in early March. So you were the last person to have that dubious honor of chatting with me face to face before we locked everything down. But of course, this has been an ongoing initiative over there at Northern Trust for quite some time now. How is that going? How is the uptake over there from the clients over there at Northern? Like we said, not a traditionally options oriented crowd, but what's the response been like? Have they been receptive to the options offering, sir?
Yeah, thank you. So yeah, the options business at Northern's just over 5 years old. We're 5.5 years old right now.
That doesn't seem possible to me. It's like 2, maybe 2.5 years old at the most.
Yeah, no, it feels like 15, but I joke. But yeah, so we're 5.5 years old. Many clients coming into the fold. Very large institutions, anything from family offices, ultra high net worth individuals, and your traditional asset manager base. For many of your listeners on the show, really bang out year, not just in volume, but just in investors really looking at the asset class and how to incorporate that into the portfolio, whether that's tactical trades or, again, systematic themes or ways just to do, traditional overrides, on stocks that I own that I don't mind parting with, or stocks that may have, questionable dividend, questionable earnings based on COVID-related issues, where I just want to kick off additional yield because of where interest rates are at. But rounding the corner into 21, it's been honestly, we're very fortunate to have a very strong first quarter. Our volumes are up well over 30% this year, so very, very pleased about that.
Interesting, because of course we have seen the trend throughout most of the market, in particular that smaller retail segment that are just on fire with options in 2020 and now into 2021. Sounds like you've seen the same trend in your larger accounts over there at Northern. But it's interesting to see that they're coming online as well. And Mr. Matt, I know you spend your days when you're not chatting with me. I know it's hard to believe. There are days when you don't chat with me, when you're out there looking at a number of other things, including all your various models for the marketplace. Like I set it up at the top of the show here, a little bit of a different vol regime we're in now than we were on our last show. Markets still kind of frothy. What is lighting up your tape out there, and what are your models telling you as we come into the latter portion of March here, sir?
Yeah, it's so great to have John on. He's got a great team over there. Northern Trust, I've had a small account there for decades, and so it's just awesome to have him back. So quite excited here. What I'm seeing, Mark, is in one of the things that we talked about before is really this whole GameStop has changed the skew. I mean, much like 1987 put in a left tail skew, to 2020 and 2021 has put in a right tail skew, and that affects not just the single stocks, but it gets over into the indexes and it gets into the VIX too. So what we're seeing is that curvature, or a bigger smile, or kurtosis happening, kind of driving. Even though VIX is a lot lower than we saw it last time, it's still it's still meaningfully above implied volatility. However, some of what we're seeing is that, there's been some historical volatility. That we look at intraday volatility quite a bit. One of my claims to fame when I had a market making firm on the floor is we would, since I was backing people, we had to simulate calculating skew and calculating historical volatility by scalping on tick data, and we tried to find stocks that we could go into that we could be at least flat or long volatility. So we've had a long history with this, and we're seeing still there's a fair amount of intraday historical volatility. So vol to me looks a little inexpensive, and I was on VolViews last week, and I think my pick was 19.99, and are you telling me that I lost, Mark?
You did lose, because I was at a 19 double, and we were at about a 1946 or so on the VIX cash and a 1961 in spikes. So I was yet again 2 weeks in a row, Matt, within our 10th of a point bullseye out there. So getting kind of scary, getting kind of spooky. I'm going to have to steal your Oracle of New Hampshire and switch it to the Oracle of Chicago going forward here, because, scarily precise in the Volatility Views prognostication. If you haven't heard Volatility Views, listeners, check it out. Just recorded it right before this program, actually. We do a lot of fun analysis of all things volatility out there. Speaking of fun analysis of all things volatility, Matt's been busy cranking away at all the earnings vol, so let's get to it. A little bit of the old earnings volatility rundown.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, listeners, yet another one of our new segments to grace us with on the 100th episode. Spectacular. Of course, Matt and his team always busy cranking away the earnings volatility analysis that you folks love throughout all of the entirety of earnings season. And we've been waiting. I in particular have been waiting. I shouldn't put words in Matt's mouth, but I certainly have been waiting for the moment when we'd see this inflection point, when all the vol that they've been squeezing out of these names for ages, ever since the pandemic began, they would finally start to come flooding back in. They would finally underprice these straddles enough where we start to see some outperformance and the vol would widen out again. That's usually the cycle we've seen play out here. And yet now going into the fifth season since this pandemic began here. And so far, Matt, it doesn't seem like we're seeing that. Is that the case, sir?
That is the case, Mark. And, it's a, I think it's still a shift. I mean, I think that the people that trade around earnings haven't caught on for some reason. It boggles my mind a bit. But, I think there has been a paradigm shift with this. People just are not as interested in the fundamentals in earnings. They're buying, there's a lot of these call buying going on, and they're just, not very interested in what's happening, the announcements, breaking down the announcements, and how much we used to see stocks move around earnings, because that was kind of the only window that these stocks had. And one of the other things I've been thinking about is, there's so much big data out there that they know so much more about these companies that the shocks aren't as great. So that's the way, I'm kind of looking at it now is why are we seeing still a hangover of implied earnings moves so much more than the actual earnings moves that we're seeing, and even in some cases as high or higher than the past earnings moves. So I'm scratching my head, but those are some of the theories that I have, Mark, around why we're seeing such an underperformance of owning volatility around earnings versus the way it used to be.
It is certainly a bloodletting. I think you assumed, many people assumed at the start of all this madness about exactly a year ago that we would see some outperformance from a vol perspective as companies were kind of just throwing their hands up into the air and saying, we have no idea what the future holds. We're revoking all guidance. Usually that leads to a lot more volatility. Instead, we saw exactly the opposite. Firms, like Matt said, and traders didn't really care. Vol came in, and that's been pretty much the case for every cycle since, and that is certainly the case with this season right now. We have a number of weeks under our belts right now, and it's averaging about a 77%. Listeners, that means 100% means you get exactly $1 worth of bang for every $1 worth of vol that you're buying out there. These days, you're getting about 77 cents back on your dollar, with some of these weeks looking pretty atrocious. 56% week one, 52% right now. So about 50 cents on the dollar for vol buyers out there right now. So overall, it's a very blood red season. You folks, as always, can check out these earnings move results, and earnings season reports. You know where to go, theoptionsinsider.com. Click on that options news and articles tab to begin your journey to the dark side of earnings volatility. If you have questions, of course, hit up Matt and his team over there at ORATS, ORATS.com. John, like we said earlier, you're not really in the retail client game. You have much different types of accounts over there at Northern. But traditionally, even for larger accounts, earnings season was a driver of volatility, of action, of many things in the market. As Matt kind of just alluded to, and as the report kind of backs up, these days that doesn't really seem to be the case. What's the take on earnings season from a client perspective over there these days? Is it still the driver of volume and activity and interest for your clients as it used to be before all this madness kicked off, sir?
Yeah, thanks, Mark. And, I agree with what Matt was just saying. However, and this is kind of a unique thing that we've noticed across kind of different client segments within Northern that really started about mid-year 20. When, we started to get a little educated on COVID and what that meant to work from home, and everybody got new laptops and set up at home to do work. And that seeing as earnings, going through a couple earnings cycles now, we have seen a significant amount of our investors and clients really getting into covered call writing and kind of what that means. Not necessarily playing the volatility of it, but as I mentioned kind of in the opening introduction, clients are trading around names, or clients hold names that they may not want to sell, but it is higher volatility than they have seen kind of in recent years on stocks that they want to own. So that, coupled with low interest rates and perhaps a reduced or dividend that's been foregone in the short run due to the pandemic, we've really seen an increase in our covered call volumes for that reason, Mark.
That's fantastic. I think one of the things people were looking forward to when they heard that Northern was getting into the options game 5.5 years ago. It doesn't seem like, I still argue that it's been that long. Maybe I'll give you 2 at the most. But that's one of the things people were looking forward to, is a lot of money that was on the sidelines from an options perspective that could certainly take advantage of very straightforward type strategies like a covered call, which you're right. In these environments right now, rates fluctuating around zero, somewhere in those levels out there. Income a little bit harder to come by. People sitting on large equity portfolios. It's a good time to be thinking about using covered calls to generate an additional, effectively a dividend stream on those types of portfolios and generate a little bit of income on assets that may otherwise not be doing that out there. So I'm glad to hear that the folks are picking up on all things covered call. And speaking of learning about their options things, let's do some of that ourselves as we keep on rolling into our Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we break down usually a basic option strategy or tip or technique and explain how you can utilize it in your own and indeed your clients' portfolios. Going to do something a little bit different today. Matt, you and your team over there at ORATS put out an interesting piece about not a particular strategy, but instead how to arrive at that conclusion of what type of strategy to use, which strategy to choose for a different environment. Kind of interesting stuff, and one that certainly I know comes to mind for a lot of the listeners of this program, the advisors and asset managers who are out there. Maybe they're in a situation similar to John. They have a lot of kind of long equity that's looking for a little bit of income. Maybe they're looking for more protective type strategies. Maybe they're getting speculative. Maybe they're all of the above. But they don't really know where to start, Matt. They don't really know how to pick the right strategy for them. So if you were going to counsel them, as you are now, because I'm turning it over to you, what would you tell them, sir?
Well, thanks, Mark. I thought this would be fun to do. I'm an RIA, and we do obviously a lot of testing. We have a couple hundred clients, and so I'd like to just step back, because a lot of these boot camps might start with a strategy, but I mean, I think you might want to just step back one step before that. And the first thing, and people are pretty good at this, they know the risk and reward objectives. You could talk to them about what's more important, $1 an hour, but $1 in 2 years, and you could tease out some of how they feel about risk, and how would you feel if you had a drawdown of X percent, and what you could do then is figure out from those questions what types of strategies might fit their needs the best. Like, for example, I'm pretty risk adverse. Like, I always have put long puts on. I'm going to do well during COVID and those, and I'm going to bleed out a little bit during the recoveries, and then I have but then I like to take some chances around, getting some theta back. So I like to do things like having long puts, but, maybe selling put spreads, having long units, but, trying to figure out how to not pay so much and have it be so punitive owning those puts. So so knowing your risk returns objectives, I think those are the first steps that you could do. And then that will get you into some possible strategies. And then obviously you want to test those strategies. You want to see how they performed. And, I think you want to optimize those strategies. For example, let's just say that put spread, that short put spread. How has that performed over, 14 years, since 2007? I think you want to have 2008 in there. And then what you want to do, I think, is then look at a bunch of different strategies, look at a bunch of different ways that you could trade that strategy, and things that you would do and can do as an investor. How much time do you have to look at it? by the way, we also have some automated systems where you could put in a strategy and it will alert you when your alerts have been met. So test those strategies out. Literally run hundreds, if not thousands, of back tests. Do some out of sample testing. So what that means is you run these back tests and they might look good for a particular time frame, but then you want to run them in a time frame that is out of that sample to see if they continue to perform. So those are the back tests. So then you get these these back tests that look good. So you might have a put spread that's 20 deltas wide, that's 14 days to expiration, that has a exit if it goes against you to 75 delta for the short put or something. You might come up with that strategy. And then what I think is a very interesting thing to do is apply volatility regimes to that strategy. Is there a way that you can identify when that strategy works particularly well? Is it working well in a 2017 scenario when the market's just going straight up? How does it do when there was duress in the market in 2018? And if you can then apply certain, IV percentiles or IV ranks, or, we like to look at how our forecast looks compared to implied, and treat that as an option environment. So we get some timing around that strategy. So, one of the books I'm reading is about, the inherent problems of individuals using their emotions, jumping off of a good strategy right before it's starting to perform well. So, the conclusions are systematic strategies are, something that investors should really look at. And so we like to be able to test and implement those systematic strategies and, really get into then, making it easy to test and making it easy to, and then paper trade. So then you want to go in and you want to just make sure that all your assumptions that you've back tested are going to work now in a paper trading environment. And we've written our own paper trader that comes up with fill assessments that we think are probabilistic and can happen in the market, and accurate times when you might go into the market. We have theoretical values, of course, that ORATs calculate. So then that paper trading gives you some comfort in these strategies that you've developed are continuing on, and you compare those to the back test. So then you could get some, you just overlay the graph of your daily profit and loss over the backtest profit and loss, and it should match very closely. If it does, then you have more confidence in it. You can start to trade small, and then again, have a system where you could be alerted. And that's some of the things that we produce at ORAT. So we want to help people trade better. We want to help people develop strategies better, but then also not just leave them there, but help them implement those strategies, test them in paper trading environment, and then actually go out and link up with some APIs or brokerage and make it easier to test. So I think that's the overall method that I like to advise to clients of knowing your risk return, knowing what strategies that you could do. Look at those strategies. Look at the drawdowns. Do you still like it? Yes. Okay, now let's do some more backtesting. Paper trade it, and then start trading it. Get these signals that you can subscribe to help you trade that system better, and then really track how you're doing. So we have we have a front end that can track how you're doing in each one of your back-tested strategies. So, that's the kind of holistic approach that I think successful traders can use to develop, test, and implement trading strategies. Mark,
I like it. We need a name for it. What about the ORATs method? What are you calling this?
Well, I hope it's everyone's method, because it's a systematic method for testing and implementing strategies. And really, I think if a lot of people have come to the options industry over these last few months, and some of them may have had success, but many of them may not have. And it might be time for some to take a step back and then get into some of these more systematic approaches to their option trading, Mark.
I like it. We have the scientific method. Now we have the ORATS method. There we go. John, I know you guys are doing a lot of this over there at Northern. You mentioned a lot of your clients are coming online now with covered calls. That's a great starter position. People ask me all the time if that's still one of my favorite go-to starter options positions when you're coming to options for the first time, particularly from the equity market. But what are your thoughts on Matt's multi-pronged approach here, aka the ORATS method? And what do you folks, what do you and your team over there at Northern, what do you do when a client's coming to you now for the first time? What steps do you take to determine what's the right strategy for them?
That's great. First and foremost, I have tremendous respect for what Matt's done, not only at ORATS, but even before, he started it. And so just hearing, Matt, hearing you and how you just articulated that approach, it's just fantastic how your business has evolved and how you're looking to educate investors. So kudos to you for that. At Northern, we're a little bit different at Northern, and it's obviously a good thing, because it shows that the industry is getting more broad and educated. That being said, the way we do stuff, when you're talking to investors about any sort of option strategy, whether it's kind of the most simple strategy all the way to the more complex, large hedge fundy type trading that you want to do, I really solve and break things down to brass tacks. Like what is the objective? What are we really trying to solve for? And can an option strategy be the part of or encompass exactly what we are looking to do from an investment thesis? And so, kind of taking the example of a covered call writer. If you have an investor who is very reticent to parting with the underlying asset, assuming they are long this asset, so it being a covered right, a covered call strategy is probably the worst thing to do, unless you're doing something kind of in a customized nature, like a European flex or something like that. But let's just kind of, for argument purposes, talk about what that looks like. If you have an investor who is willing to part with stock, at X% higher than today's valuation, and is agnostic as to when they do so, a covered call right is an outstanding way to create an elegant exit out of a position. Meaning, I'm a patient seller, but I'm willing to sell at a certain price to me, and likely you folks as well. I'm a seller of stock, GTC. So it's no different than, to be a limit order to sell shares. And so I really take that approach, consultative approach, with any type of client that we have, whether that's, again, on doing something that's more of a yield enhancement or even straight hedging, and looking at hedging strategies as well for any investors, Mark.
A lot of different ways to peel the onion out there. These are just two. I know you, as you're working with your clients out there, maybe you have your own questions about how you should apply it. Of course, check out what we just broke down here. You can hit up Matt. Of course, hit us up on the show as well. We have some great questions coming up in the office hours in a little bit. But first, before we get to that, we have to check the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody. Welcome to The Buzz, a portion of the show we break down the hot action in the world of options and derivatives, and sometimes beyond, that you might have missed since our last show. And we're going to go beyond for this first story here, because it's kind of taken up a lot of the oxygen in the room these days. And certainly, John, since the last time you were on the program with us, this has become much more of a mainstream type conversation. Of course, I'm talking about crypto. Big news hitting this week. The Morgan Stanley going to offer Bitcoin funds now to its wealthiest clients, as they term it, only the clients with a quote unquote aggressive risk tolerance and at least $2 million worth of assets are going to have access to these Bitcoin funds. They'll enable ownership, obviously, of Bitcoin for folks out there who are looking at this. This kind of just reflects the trend we've seen, certainly since 2021. I mean, I can probably count on one hand the number of times we mentioned Bitcoin on this show and all of the episodes prior to 2021. And now, of course, in just this past quarter, the world has changed yet again, certainly from a crypto perspective. Bitcoin blowing past 50,000. Of course, it turned the other way, crypto all yesterday. So interesting times foot out there in the crypto market, but certainly has become much more of a mainstream product. We're seeing much more institutional interest, much more traditional asset manager interest, and that usually trickles down into some client interest as well. So I'm curious for you, John, over there at Northern, what kind of interest are you folks seeing from the clients in terms of this crazy new asset class known as crypto, John?
Yeah, so a lot of chatter, a lot of conversation on it. Certainly, with the volatility that you are seeing in Bitcoin, that generally sparks readers' interest in looking to talk about that. No different than any of the meme stocks that have been discussed throughout the first quarter. Brokerage within our brokerage business ourselves, we're not investing in any of that stuff, so we don't support it. But that being said, the rise of these kind of Bitcoin or crypto ETFs, if you will, are certainly something that we will help clients transact for. But yeah, nothing really on the horizon with respect to us getting in that space or supporting that currency being held within brokerage accounts. Mark.
I know, Matt, you were an early watcher of this space. I think of late you become a little bit more, shall we say, agnostic on the whole mad run up and now just volatility, even though the vol coming off substantially out there in Bitcoin as well. But Matt, I'm curious, has your views changed since our 100th episode spectacular on all things Bitcoin and crypto, sir?
Well, as you know, Mark, I have some ambivalence. And, when you started your crypto show, I think I was one of your earlier guests there and have been exposed to crypto for many years before that.
By the way, that show just hit 100 episodes this week as well. It's crazy. Another little engine that could.
And like, I would invest in it but not really believe it in my heart. I don't know how to say that. So that's where the ambivalence comes from. I like a lot of the things that it does, as many other people do. You wish you could invent a different crypto, and there obviously are many out there, but Bitcoin being the biggest and that. So first of all, it's with NFTs, non-fungible tokens, that's getting a little crazy. But there's this, when you have this much money sloshing around out there, you're getting semi bubbles in equities and cryptos, I think, and even in these kind of secondary, tertiary markets. It's just, I think it's endemic of what's going on a broader scale. There's just a lot of money out there looking for a home. You can't get much in fixed income, so they're trying to find where we could put it. And there are arguments for Bitcoin as a fiat hedge, but there's a lot of we see the volatility up at 100 now. It's down around 60. So it's difficult to argue it that way. But again, there are some nice things about it. Obviously, it's portability, your ability to bank with it. So again, I still have that ambivalent look at it. It seems pretty high, but there's a lot of interest in it, and now that it's coming more to mainstream, I worry a little bit that people are just getting in now when, I've known people in it since, it was $5 or something, I think was when I was exposed to it. So it just seems so odd to me. It's just like a weird world of crypto, Mark. So I don't know how to put it other than that.
It is a weird world indeed. We were talking about it yesterday on our TWIFO program. Of course, they're putting up some numbers over there at CME from a crypto futures and options perspective. And our guest, Dan Grams, put it well. He said, in that marketplace, there's nothing really behind it but good intentions. And that's entirely the case. There really are no fundamentals. And outside of a few utility type tokens, there really isn't an underlying value that's inherent to the product out there. It's really just what the next person will pay for it. Hence the massive fluctuation we've seen. Again, even though that vol has come in a little bit, if you're intrigued by all things crypto, I encourage you to check out the Crypto Rundown, hitting episode 100 this week as well. A lot of fascinating stuff. When that show launched, it was back in the teeth of the crypto winter. Bitcoin was threatening the 3,000 handle to the dark side. It had just sold off another 20-odd%. It seemed like in just the past couple of weeks before we launched that show, people said we were crazy to launch a crypto show. That asset class was a fad. It had gone the way of the dodo. And look where we are just 100 episodes later, listeners. Quite a different ball game. Speaking of different ball games out there, this year, everyone expected 2021 to kind of be a different ballgame, to be maybe a little bit quieter, a little bit calmer, certainly less turbulent than the madhouse year that was 2020. And yet the year kicked off, of course, January 6th with the Capitol Hill insurrection. It kind of never looked back from there. So it's been another tumultuous year. And one of the things we've seen as a result of that is options volume. A lot of people thought coming into this year, maybe it would fall off. Last year, kind of an outlier year, an insane year, a pandemic. You can't really count that as a normal year. And yet so far this year, volume numbers staying apace. We talked about January being the most active year in the history of the options market, beating the previous record, which was December, the month before. And the numbers are clearly in for February. We're close to having the numbers for March. Don't have them finalized yet. Of course, we'll have those on our next episode or even on the option block next week, listeners. Stay tuned for that. But the numbers are in for February, and February also looking strong yet again, up 45.5% from this time a year ago. Of course, this time a year ago, February, and everyone remembers March as being the beginning of the big tailspin. But actually, in February, we started to see more of those systemic shocks, more concern about the virus starting to spread, and some big sell-offs towards the latter portion of February. I do believe on February 20th was where that worm started to turn. I remember when John and I were meeting last year in early March at RMC, we had already seen multiple periods of shocks to the system out there. So it wasn't just like last February was a sleepy month and then it all took off in March. Last February put up some numbers too. And yet this year, 45.6% increase from last year. Also the second highest month ever outside of January. So again, it even beat December. So we're talking some numbers out here. Total volume in February, 828.5 million contracts. That puts their year-to-date ADV up 61.4%. It's up to 44 million contracts a day now through February. That's some serious paper, listeners. Let's break it down really quickly. Total overall volume. Remember, OCC clears some other stuff outside of options. So we squeeze out the options from that. Total exchange listed options was 823.4 million. It's up 47.5%. Dig a little bit further. Equity options, that was 786 million. Of that, it's up about 55% from this time last year. That includes cleared ETF options. You pull those out, that was 213.6 million. That's actually only a 2.4% increase, which is kind of interesting on the ETF front, a little bit lagging. Same deal for the index options. They've been kind of one of the few dark spots in the option space of late. Index options, 37.3 million contracts. That's down 26.5% from February of last year. And year-to-date ADV from an options perspective, 43.7 million. Futures, also another light spot. Remember, OCC predominantly now clears VIX futures because, of course, the Cboe Bitcoin futures have gone the way of the dodo. They cleared about 5.14 million contracts. That was about a 49% decrease. So yet again, the VIX futures complex continues to get annihilated from a volume perspective out there. I know, John, I can't imagine these numbers come as a surprise to you. You're seeing this on the business end over there at Northern Trust, this demand ticking up. So I can't imagine these February numbers would surprise you. And also, if you blow the doors off again in March, probably won't surprise you either, John.
Yeah, I love it. The industry, gosh, in the last 22 years has really evolved from an option standpoint. So it's even great to see from mid-teens to today how volumes are doubling kind of industry wide. It just shows kind of how the exchanges are certainly more efficient, even though there's 15 of them, and the OCC and the OIC and especially the Cboe are doing all the right things. And Mark, I got to tip my cap to you. It's, I'm sure, part and parcel for some of the education you're doing on the podcast. So I think it's fantastic how we're all educating investors. Volumes for Northern, we are largely the same. Overall volume up 30% year on year, especially comparing first quarter last year to first quarter this year. I echo the ETF volume is pretty much flat for us. Single stock activity is what's up for us, triple digits. And so that's been, like I said, kind of on the traditional overrides and things like that, with investors looking to sell stock as well through covered calls. So the exercise and assignment piece. Lastly, on the index front, And it's kind of, it's probably old news now, but I think that's worthwhile, at least for the three of us to talk about. Index volumes were off the charts for us last year, which should be no surprise given the volatility that's happened. We've seen that dramatically right size to normal volumes early first quarter. So I echo kind of what you shared with respect to the overall OCC volumes that were published.
Interesting stuff. And I also will take credit. We probably account for, you got to give us at least $1 million of that $823 million. What do you think? Maybe $2. What do you think for that total out there? We're not greedy. We'll take a couple of million off that top for the total and put it towards our audience. They're a pretty active bunch, and you're also pretty active on the question front. So let's dig into it as we open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours, the portion of the program where you folks take the reign with your questions, your comments, your pearls of wisdom out here. Let's kick it off with Nikos. It's like the way he puts it in his question. He says, can you describe the delicate dance between strike, delta, and option premium? I tend to buy calls when I think the stock is going to hit that strike within the allotted time frame of the option. Is this too basic of an approach? Should I be concerned about theta? Well, a lot to unpack there. You touch on a lot of topics in your deceptively simple question here, Nikos. But Matt, maybe we'll start with you. You just broke down what we're calling here the ORATS method for how to choose your strategy. Nikos is looking to buy some calls. He just looks at the strike. He says, I think it's going to get there by expiration. I'm going to buy it. What's he missing, Matt? What should he be adding to his analysis?
Well, Nikos really points out so much in this question that, options, unlike stocks, have many more moving parts that, it is difficult to think about all these. And this is part where experience comes into play. I remember my first trade on the floor. I bought a straddle for $5 and my backer, you bought that straddle for $5, and then I go,
anyway, the market moves, you win, Matt. I don't know if you heard
that. So, and you learn, you say, well, how much does my stock have to move? Where do I need to delta hedge that, et cetera? So you learn with experience. Well, my answer to Nikos is, one thing that you could do is test that strategy, look at, and then watch what happens with many, different options. So you can, in effect, get your experience level higher and higher by looking at, simulated trades from the past. So, but definitely, I mean, and it is a delicate dance, as he puts it. I like the way he says that, between strike, delta, and premium. And this is what, a lot of these retail players in the market are coming saying, hey, I want to buy a call. I want to participate in the stock's appreciation. Well, as we know, they're buying some of these calls that are way out of the money with incredible implied volatilities. Sometimes even when the stock moves, they'll lose value. So yeah, it is a delicate dance. And, there are ways to look at these in the past, look at these calls, and is this the best strategy? And I think what the people will find is there are often different strategies that will simulate volatility movement, simulate stock movement, and that might more closely approximate the risk return objectives of these people that are trading options. So they're, as they get more sophisticated and learn more, there's more than just buying calls. There's call spreads. There are even call butterflies that will behave in a manner that would give them more money for if they're right than just a call might. But yeah, there's a lot more to it. Yes, you should be concerned about theta, and it probably is too basic of an approach now. And I hope that Nikos gets more into it tests more strategies, and finds out a little bit more than just a long call, which is mostly for people the jumping off point, Mark.
These days certainly is. You mentioned the call skew getting bid up across the marketplace. A lot of people are diving in with these long calls. John, I'm sure you've had conversations like this with clients over there at Northern Trust. They say, hey, I want to get into these options things. I think the stock's going to go up. I think it's going to be past this strike. I just want to buy these options. I don't want to care about any of this other stuff. What do you have to say for clients like that, or like Nikos when they come to you with that approach, sir?
Yeah, not too much to add more than I think Matt hit it nail on the head. I think looking at the components of skewness, delta, and frankly, all the Greeks is something that any investor should be doing for purposes of our clients. They don't tend to really care about the Greeks necessarily. That's likely why they're paying us to look after them on their behalf. But I tend to agree with Matt that long calls, when you're doing the simple option strategies or long puts, is really just a jumping off point.
Yeah, great, deceptively simple question here, Nikos. But yeah, it is unfortunately too basic, like Matt mentioned. If you pay infinite amount of money for that option, doesn't matter if you hit your strike, you still have to go well beyond it to make that option pay off. And of course, theta, if you're not right in terms of a time frame very quickly when you're buying premium, you can see that option erode away to virtually nothing. You can get stopped out on that option before the move even happens. And then, of course, you're out of luck because you lost all your money on your options premium or whatever portion you had before the stop order there. And then the move happens and you're out of luck. So there's a lot of reasons why you need to pay attention to other things, even though I agree it would be nice and easy and simple. I just want to get to that strike by that time. That's all I care about. But there's a lot of other moving parts out there, as Matt broke down in his 6-part ORATS method for discovering your own strategy out there. All right, next up, we've got Max 344 wants to know, do you think this is the time? Do you think this is where we'll be for much of the year? Markets bouncing around all-time highs and VIX also bouncing around 20. Are we doomed to watch this movie play out over and over again? Well, I will say this, Max 344, we do a lot of vol prognostication on our volatility views program, and for pretty much the entirety of the last year, most of the people on the panel have been fading vol week in, week out, and saying, here, we're going to see less vol next week, less vol next week. And it has mostly worked out. This is the first time I can remember in quite some time where a lot of our hosts actually picked higher vol going in for the next couple of weeks, which is kind of interesting. Again, that's just a very near-term indicator, but an interesting one nonetheless. But John, he raises an interesting question here. We've kind of been in this little bit of this spot for the better part of the last month or so, volatility hanging around 20. It can get through it as it did again today, but then it kind of rallies back up as it did this week. And so we're kind of left with this endless tug of war around the 20 strike, and also the equity markets hovering at or near all-time highs from a valuation perspective. Do you agree with Max? You think we're going to be seeing this movie a lot this year, sir?
Yeah, I'm going to deviate slightly from the traditional northern thinking here and put on my full options hat and think that there will be a good amount of chop this year in 2021. It wouldn't surprise me if you see us go back. Mark, I did kind of your VIX Vol show a few months back as a guest, and I was in kind of the 30-32 range, sustained, and I was clearly dead wrong on that. However, I do think that we will see some chop, so it wouldn't surprise me if we kind of go back to those levels and see a more broader correction within the S&P and Qs complex. That being said, I've been around long enough to know that you don't want to bet against the Fed. And so the market's kind of staying where we are, longer term, if not higher, well over 4,000 on the S&P, would not surprise me either, Mark.
Mr. Matt, as you mentioned at the top of the show, you're always cranking away your models, particularly on the vol side of the space. What do you have to say for Max, who is wondering if we're going to be seeing this movie play over and over again throughout the rest of the year, sir?
So what I tend to do is I look at our volatility signals, and generally they don't look out that far. They look over the next few weeks, next few months. So I don't even try to get into what the real smart people like John could do and look at the overall macros and all that. But for me, I from a trader's perspective, market maker's perspective, look what's happening. Find your numbers that are working for you. Find your triggers that are working for you, and I've talked about contango, which is the relationship between the front month volatilities and the back month volatilities that will help you, see what the big money is, how they're pushing around volatility. So generally, when you're in contango, and we have a measurement for it, and we chart it, when you're in contango, that's usually pretty good for the market. And then we also have some more obscure readings, like forward volatility relationships. When they start to get out of whack, that's generally bad for the market. So what I'm seeing now is it's actually, not too bad for the market. This market looks still relatively healthy from a volatility perspective, but that's only looking at a few weeks. So it's hard to go the rest of the year. So that's how I'll couch it, Mark.
A little bit of a political answer there. I like it, though. Good stuff. People are so patient. They write in so many great questions. They wait patiently for their answers. Let's see if we can squeeze in a few more here before we wrap up the show. It's going out now. John, you were talking about index options growing quite a bit over there at Northern. This question comes from Divanesti Tridesetri. Hopefully I didn't butcher that too badly. He wants to know, what happens when index options expire in the money? Well, John, you folks are slinging a lot of index options over there at Northern these days. What do you have to say for Divanesti here? What happens when those things expire in the money, sir?
Yep. So kind of any of the traditional index options, but we'll focus for purposes of the question, SPX and VIX. Those are cash settled options. So nobody wants to take delivery of 500 names if you're trading SPX. And so what the exchanges do and the OCC is they settle those contracts in a cash settled manner. The other benefit, which is part of the reason why a lot of our clients are starting to use them, is they have the index options have favorable tax treatment as well. So Section 1256 being 60% long-term cap gains and 40% short-term versus kind of the ETFs and single stock, which are treated largely as short-term capital gains. Mark?
All right, and we'll wrap it up here on this one. This one's pretty much directly for you, Matt. So we're serving as support for URATs. I like it, though. Big Rock wants to know, I have a strategy idea burning a hole in my brain. Well, that sounds painful, Big Rock. You've got to probably want to let it out. He wants to know, how do I test it with Matt? So, Mr. Matt, if Big Rock or anyone else out there is curious, they want to get access to your back tester, where should they go? What should they do?
Yeah, that's we help a lot of people with these every week. Generally, you go to orats.com, sign up for a trial. You could get on and run your strategy. If the strategy, you're not able to find out how to replicate it, usually you'll email me the URL of the back test, and either me or one of my staff will try to help out as we can. We've over the 10 years of development of our back tester, we were able to perform at least close on almost every option strategy. We put in as many things as we possibly can, and we've made it as flexible as possible. So hopefully we could get Big Rock's brain hole problem taken care of, Mark.
I like it. Check it out over there, Big Rock, and everyone else who's intrigued by the back tester. Unfortunately, that music means an hour flies by when you're having fun in the world of all things advisors and options. But before we go, a lot of fun to have Mr. John Cherry back on the show. John, if folks are interested, maybe they currently are Northern clients, or maybe they're thinking about becoming Northern clients and they want to learn more about the options offerings over there at Northern, or maybe they're an advisor, they want to work with something you guys have cooking over there, where should they go? What should they do?
Yeah, thanks, Mark. And always good to talk to you and Matt. For any of your listeners interested in learning more about Northern's offering, northerntrust.com, or please feel free to reach out to me directly, jvc4@ntrs.com. Thanks, Mark.
There you go. He gave you his email. Make him regret it. jvc4@ntrs.com. Hit him up, deluge him with your questions over there. Mr. Matt, we just talked about your back tester. That's kind of just scratching the surface of what you folks have to offer over there at ORAT. So if our listeners head on over there to orats.com, what will they find, sir?
Yeah, it's been a lot of fun, and my development team's been doing a great job. Not just back testing, but optimizing back testing. So we've got a huge AWS presence with a parallel cloud computing. We can run thousands of back tests, in sample, out of sample, then test hundreds of thousands of possible triggers. When is the best time to trade this strategy, and can we replicate it out of sample, and can we replicate it with paper trading? And we put this whole paper trading and automated paper trading system down, and so it's very cool. You could follow your back test and get alerted when it might trade. So we've really trying to take that systematic research approach and implementation and make it usable to our clients. So that's what we're doing over at ORATS, Mark.
There you go. Check them out. ORATS.com, ORATS.com. And of course, you know where to go to learn more about all things options over there. Optionseducation.org. Our friends over there at the OIC doing a lot of great education. Click on the Advisors tab to learn more, get access to the research, the data, all the other fun stuff they have cooking over there. And on behalf of everybody over there at OCC, and of course, Matt, his team over there at ORATS, and John, everybody over there at Northern Trust, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in your questions. Keep them coming. You folks are the reason This Is a Little Engine That Could is now on episode 101, and we'll see you back here next month for episode 102 of The Advisor's Option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.